In today's episode of Joe Knows Retirement, we're going to be talking about the big purchases in retirement that everyone either thinks about or dreams about or is hoping to be able to do, right? And we're specifically going to talk about that crowd who has $1 million or more saved and who has a pension. So if you've been watching this channel or you're new to this channel, you know this is all what this is about here that we talk about. This is the Midwestern millionaire, those hardworking people with Midwestern values. You don't have to live in the Midwest to be a Midwestern millionaire. We have clients on the West Coast, East Coast, and the South, the North, all over the place who have these values. Some call them the middle class millionaire, some call them the blue collar millionaire. You know, whatever you call yourselves, if you have these traits, then you're going to find this video very helpful. But also, we hope that this can help lead to a more fulfilling and enjoyable retirement, because these folks have worked so hard the last 30 or 40 years to get to this place, and we want to see them enjoy their retirement there.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
So my name's Joe Schmitz. I'm the CEO and founder of Peak Retirement Planning. And as I mentioned, we serve those Midwestern millionaires, 1 to 10 million with a pension. And we see this as a very unique crowd. You know, less than 20% of people have pensions. You know, less than 10% of people have $1 million or more. When you combine those two percentages, you're looking at a 2% of the population in this specific category. And that's who we serve, and that's what this channel is all about. And so if that is you and you want to get more content on this, go ahead and subscribe to our channel, and we'll be able to send you uploads. You know, whenever we have new posts, we do 2 or 3 new videos a week, and it's all about, you know, this type of persona is who we talk about. So hopefully that can be valuable for you there. So we get a lot of clients. Let's just kind of start with, you know, this whole concept of spending money in retirement. So we get a lot of clients that they're very frugal, right? That Midwestern millionaire, they're very frugal. All they've thought all their life is save. And now they've gotten to retirement, and now it may be considered the time that they can spend money. But as we know, the best savers are the worst spenders. And we see that every day. I mean, we have to hold clients accountable to be able to spend money. I mean, we had a client, you know, they came to us when they're 60 years old, and they said, all right, I want to spend as much money I can over 10 years. And they had been retired for a few years, and we said, all right, what have you done now? And they're like, well, we haven't done anything, because it's a paradigm shift, right? So we have to hold them accountable, and we showed them the calculations, and we showed, hey, you can spend X amount of dollars per year over the next 10 years, and you're not going to worry about affecting any goals. You're not going to be worried about running out of money. And you know what they said? They said, I can't spend that much money. And they've been trying to, and they can't do it, because that's who they are. And so that's what we really have to encourage these people of, is that you're in a different place, right? You're now in a position where you have the ability, you have what I call financial freedom, to do whatever you want, whenever you want, with whoever you want. And that's the freedom you have because of all the hard work. You know, assuming you are in that $1 million or more with a pension, you're in a unique place. You're going to have a high income ongoing. Only 20% of people have a pension. You're blessed with that. And having $1 million or more, only 10% of people have that. You're in a situation where you now have the ability to do what you want to do here. And that's a shock for a lot of people, because a lot of people don't think of themselves of ever being able to get there. They've always had that mentality where it's, I hope I'm going to be okay. And so what we have to do is, a lot of times we have to tell clients, you're not worried about running out of money. We're worried about you not fulfilling your retirement and enjoy what you've worked so hard for. I'm worried about you getting 5 years down the road and saying, hey, I wish we would have done more. I regret not doing more, right? We want to see you go on the trips. We want to see you enjoy it. And we tell our clients there's only 3 things you can do with your money. You can spend it, you can gift it, or you can give it. You can't take it with you. You know, I'm a believer, and so when I go to heaven, I know that I can't take anything with me. I don't want to take anything with me. I know exactly what I'm going to have there. So we've got to make sure we utilize this and be the best steward of our money while we're here on earth. And so that could be for some people, if I want to spend the money, right? I don't want to give the money to the kids. I don't want to spoil them. We've already taken care of them enough. They don't need any more money. Some of it may be, I want to take care of my kids now so they can enjoy it now versus when I pass away, because then when I leave them $1 million, they're not going to know what to do with it. And others want to be more generous. People want to give more now, or maybe when they pass away and they want to see a big statue of themselves or have the building named after them, right? I know a lot of Midwestern millionaires that we work with don't like that idea, but they do like being generous and helping out a cause that's bigger than themselves. And we have clients that love to do all 3. And those are the most fun, that I feel are the most fun to do, because you get to see the impact all around. And you get to see what they've worked so hard for be valued and encourage others to be in a better spot and just live a life of impact, right? And it's fulfilling, right? When you can give, they say that's one of the most fulfilling things in the world. But we also enjoy telling our clients, hey, go on that nice beach vacation. You earned it, right? You deserve it. And then to see their smile and see the pictures when they come back from that, it makes it very, very enjoying. So that's the first thing we always try to say, is that it's okay to do this stuff. And we actually had a client just recently. They actually went out. They never really spent any money when they were working. And now that they are retired and they've got a giant pension, they've got $1 million or more. And so now at this point, they basically said, all right, we're going to go buy the beach vacation. We're going to go buy a boat for the beach vacation. And here's what this client told us. They said, we don't feel guilty about buying the second home because we knew we sacrificed all the years raising the 3 kids to be able to get to this point where we could do that. But they said, we sinned. And we sinned because we bought this boat, and I don't think we should have bought it. And we're just sitting there like, you have not affected any goals. You are getting enjoyment from this boat. What's the problem? I'm a little confused. The problem is what got you there doesn't necessarily have to get you there, right? And so it's a paradigm shift where they now have to transition to say it's okay to spend money. It may not have been okay early on with 3 kids to spend money because then they maybe have to pull out the credit card, right? But they have the ability now. And so we had to encourage that. And so that's what I'm talking about here. And so that's what we're also going to be talking about in this video, is how do we do planning around needing a lump sum? And when I think of a lump sum, I'm thinking of, $20,000, $50,000, but even upwards of $100,000 or more. I mean, we've helped clients get large amounts out of their investments to be able to cover high interest debt that they may have gotten from a second home, or maybe as a boat, as we're talking about. His boat interest rate was about 8%. And so that was something that we needed to find a way to get $200,000 out of his investments to pay off this boat loan. And so that was, definitely wasn't a consideration, but we definitely wanted to do that because we told him, like, hey, you're pretty conservative. We can't really find any investment options out there at a guaranteed 8% rate. Let's try to pay that off as soon as possible so that now we don't have to worry about having that interest continue to creep up, and we can just be wise with the money that we have there. So I'm going to talk about some scenarios and ways that we can be able to get these lump sums. And one is obviously if you have a pension, just take the lump sum pension or the partial lump sum pension option that you may have. So I say that very carefully. Don't just do it to make a large purchase. You got to run the numbers. If it doesn't make sense for you to take the lump sum, then you shouldn't do this, and there's other ways you can get that money that you're looking for. But if you can justify that the lump sum that they're giving you is going to be more beneficial than the ongoing payment, we have a lot of calculations to help our clients decide if that's true or false to make sure they don't make the wrong decision there. But that can lead to, a lot of success of just, hey, here's $200,000, $300,000 from the lump sum pension. You could go use that to pay off the boat, or to use it towards the home improvements, or for the second home down payment. So I do want to be aware, though, most pensions, when you take that lump sum, it is going to be a taxable event. So something we may consider is, it's $300,000 we're taking out from the lump sum. Maybe we take out $150,000 to pay off half the loan this year, and then maybe we wait till the next year and we move that lump sum to an IRA, so now we don't have to pay taxes on the full amount. Maybe we take out the other $150,000 the next year, so we don't force ourselves in the highest tax bracket possible. So you get how you can be strategic about how you do this, and even though you don't get the money right away, it's okay to have debt as long as you have a plan of how to pay it off. And if it's a higher interest debt, we typically want to try to pay it off faster. But if you've got a mortgage that's 2 or 3% from the old days, probably worth keeping that in place just so you can have that liquidity and flexibility. Now, we do have some clients that just say, I want to erase that mortgage. I don't want to have to worry about it. I understand I'm going to miss out on rate of return and the interest deduction when I itemize my taxes, but I don't want to have to worry about it. And so in that case, well, we're going to help them pay that off if that's their goal, because sometimes emotional goals can be just as important as financial goals when you're in retirement, if you have the ability to do whatever you want, right? There's a lot of things we spend money on that may not be the smartest thing or the wisest thing, but if it gives us joy, that's okay. And that's the idea of paying off the mortgage is ultimately the consideration there. The other consideration I really want to point out here, let's say you don't do the lump sum, or let's say you do a partial lump sum and you still have that pension coming in every month for the rest of your life. Well, first I want to understand of how much of that pension do you have, right? Do you just have a small $1,000 to $2,000 a month pension, or do you have something that's more generous, like a $5,000 or more a month pension, right? I mean, if you have $5,000 a month, that's $60,000 a year of pension income, and then probably Social Security on top of that, and then all the investments that you've grown over the years as well. If you have a $10,000 a month pension, well, you're making $120,000 a year from your pension without any Social Security or investments. And we have a lot of clients who make six-figure pensions, and that's where it even becomes way more unique when your pension's that high. And we've even seen some clients with a couple $100,000 pensions or more, and so that's where the planning starts to get really unique. So the point I'm making on this, if you do have the pension, my point here, I'm going to say it very cautiously because again, I don't know how much your pension is, but trust your pension on some of these bigger purchases. And so you just have to understand that that pension is going to allow you to have that guaranteed income forever. And having a pension really increases your net worth, in my opinion, because if you have a $60,000 a year pension, I mean, that's the equivalent of having at least $1 million in investments, right? If you had $1 million and you said, hey, I want $60,000 a year from that, that's really the comparison that we're looking at there. And so just trust that you've got a great situation. If you got a $60,000 a year pension plus $1 million saved, plus your house may be paid off, I mean, you may have a $2-3 million net worth, and that's going to be top 5% in the entire country. And so you're going to have more flexibility, freedom to spend money is ultimately the idea. So we'd always consult you. We'd always advise you to make sure you're running out the analysis before you go make all these big purchases. Let's make that very clear. I should have started the video with that. But just understand that, if you can show that you're going to be successful, even with taking $100,000 out or $300,000 out to go do what these things you want to do early in retirement, then go for it. And the other consideration too that we always think about is the go-go years, right? You may want to take out these lump sums earlier on in retirement because that's when you're going to enjoy it the most, versus when you're 80 years old, you may not be able to enjoy it as much. So we do a lot of planning with our clients where we help them spend more early on in retirement than we do, later on. Obviously, we need to make sure we're protected later on and just not spending everything up front. We got to make sure it's a solid plan with no gaps or no holes in the boat, as we always say, as we plan moving forward. And, we always typically, I don't want to say always, but we mostly do Roth conversions for clients or doing something early in their retirement or while they're still working to increase their income. You probably always say, we want to pay less in taxes. Well, that's a good thing, but actually right now, with tax rates being historically low right now, and knowing that you're probably going to be in a higher tax situation in the future, being a diligent saver with a pension, we like to do things that increase our income early in retirement. A lot of that involves a Roth conversion, right? Where we take money out of our IRA, or we don't take it out, we move money from our IRA to a Roth where we pay the taxes now on it, increases our income. But later on, when we go take out money from the Roth, it will not increase our income because it's all tax-free. So maybe if we're thinking about, hey, over the next 3 years, we're going to be planning on doing around a $200,000 Roth conversion. Maybe we're going to go up to the top of the 24% bracket. Well, maybe instead of doing a $200,000 Roth conversion, maybe we only convert, $100,000, and then instead of converting 200, we just take the other 100 that we were going to convert, and maybe that's our spending money now. And so you can see we can just use it as part of our tax plan to make sure we're maximizing the brackets each year. So a lot of you may want to even look for an excuse to spend some money right now, and that could be it. Maybe instead of doing that strategic Roth conversion, maybe you just do partial Roth conversion and partial withdrawal to be able to do what you want there. So obviously the Roth conversion may be more beneficial long term, but that, again, that's the question you have to ask yourself is, do you want to have more enjoyment now, or do you want to have bigger barns for the future? And it's a question I really challenge people to think about of what do you want to do with this wealth? You don't have to spend it. Some people may not get a fulfillment from spending. Maybe they get fulfillment from saving and being frugal, and that's who they are. And maybe they want to leave a big impact to their church or charity or, to their loved ones when they pass away. So whatever that may be for you, I just challenge you to make sure you think hard about what that is. And the other consideration is what other vehicles do you have to do these lump sum purchases? Maybe you have more saved up in your bank account that you've had that you can access and take it out and pay. Or maybe you have the non-qualified type investment or a non-retirement account where you pay capital gains on it. And maybe that's an advantageous thing that you can do. You got to watch out for the capital gains you may pay on selling off specific stocks and funds, but maybe that's where you go so you don't have to worry about the ordinary income on that. And that could be the way that you plan for some of these purchases. And also with this, let's say you retire early, you do have something called the Rule of 55 that you could tap into your 401k. You may not want to move everything over to an IRA as soon as you retire if you're in that boat, so you can still access it without a penalty. If you move it to an IRA and you access it, it could be a penalty, so be aware of that. But this could also be another way where you can access your money without a penalty before you're 59 and a half from your retirement accounts, is through this non-retirement type vehicle. And that one you can, also if you have, maybe you don't have as much capital gains in that type of investment, well, now you can start to take out more money without worrying about the tax impact. Remember how we talked about earlier of being aware of taking out too much? If we want $500,000 to go buy a boat, well, we may not want to take that all out in 1 year from our IRA because we may bump up our tax brackets really high. Maybe we could take out some from our IRA, some from the non-retirement, some from our bank accounts, and now it can be more efficient as we plan there moving forward. So those would be all the considerations. So I hope that gives you perspective and idea as you look to make this jump of making this big purchase. Again, this is maybe one of the bigger purchases you've ever made in your life, and I hope this video can be productive for you. But I guess the main thing I really want to address here today is just run the analysis, and the analysis is green. If it shows that you can be successful, then go do it. Go enjoy that retirement. Go spend your money. Go do what you're planning for. And if this is the type of planning you're looking for, maybe your advisor has told you all these years, save, 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 save. Don't spend your money. Don't spend your money. We hear that a lot because obviously advisors make more money as their clients invest more and as their investments grow, which is great. It's great to be aligned there. But also you want to make sure you can spend it and enjoy it and give it in the most fulfilling way. And so we always tell our clients and encourage them of that. Hey, if we make a few more less dollars, but you get to enjoy and live what you want, I think that's a good deal, and I think that's what we're here to do, right? We're here to serve. Yes, we're here to make money. We're here to have a business and grow the business and help more people. But at the end of the day, we're here to serve people, and that means getting done what they want to get done. So if you're looking for that type of planning, go ahead and schedule a time below, and you can schedule time to meet with our team here. I do want to be transparent as always. We do not bring on every single person that reaches out to us. This is an opportunity for us to see if we could be a good fit to work together. If so, we'll schedule another session, and in that next session, we'll answer any remaining questions and then decide in that session if it's going to make sense to move forward or not. So just make sure you're aware of that. But if you schedule that time and we can't help you, then we'll make sure we guide you in the right direction there. So that's all I've got on today's episode of Joe Knows Retirement. Go spend your money, go enjoy your money. Just make sure you've got a plan in place to make sure you're successful. Have a great one.